everyone. Welcome to Code Chat with SC Codeworks. I am Amy Dean. I'm the Vice President of Operations for SC Codeworks, and I'm here today with Tony Baldwin, our Director of Pre-Sales and Implementation.
Hi, everyone. It's great to be here today. We're glad you joined us. I'm looking forward to today's topic.
Me too. You know, most 3PLs say their biggest challenge is winning new business, but the reality is that many are losing money on work that they've already won. So today we're going to talk about that. We're going to talk about where the money's going, how to find it, and how to start recovering it. And you can start with a simple audit that you do yourself.
And this can also be a difficult conversation to open up, with your peers. Many of the 3PLs struggle on their own internally, crunching numbers and trying to figure out why their estimates aren't translating into revenue.
That's right. We really wanted to open up the conversation and talk about the patterns that we often see to help give you a starting point to auditing your own operations.
Exactly. If this is something you're seeing in your own operation, just know you're not the only one. When we look at small to mid-sized 3PLs, we typically see anywhere between 6 to 9% billable revenue isn't making it onto the invoices. To break that down, a 3PL earning around $10 million a year, that would add up to about $600,000 to $900,000 per year. Looking at a 3PL double that size, you're looking at $1.2 to $1.8 million per year.
Those numbers really show why this is such an important topic and process to spend time digging into.
Absolutely. And this shouldn't be an afterthought, but rather something considered at the very start of a new account or a new system if you're implementing one.
So important. So let's jump in. So what we're going to talk about today is we're going to walk through why this billing leakage is happening. We're going to discuss the 6 biggest profit leaks that we've seen in practice. And then we're going to talk a little bit about what high profit 3PLs are doing differently. And we'll end with some Q&A as well. We're going to start by talking about why billing leakage happens in the first place. And let me preface this by saying nobody wakes up and decides not to bill a customer. Oftentimes, the process simply makes it too easy to miss billable events.
For sure. This is not an intentional action of operational teams, but billing leakage is very rarely a fraud or negligence.
That's right. And we want to focus on things that 3PLs and operations teams can control. So Tony, can you please talk to some of the big reasons why companies don't see this happening?
So a lot of the time it boils down to the visibility and timing. It's really difficult to see a pattern or a red flag when you're not able to see the whole picture. And I'm talking about, reports and dashboards, but there's also, deeper than that is with your metrics.
Interesting, because a lot of the time dashboards and reports are almost like a security blanket of sorts. You feel better being able to point to them. But what you're talking about with metrics is really more about what sets the standards that are behind those visual cues.
That's exactly it. So it's great to be able to see the results of the measurements, and it feels good to see that. But what's driving them? Are you measuring the activities that are directly impacting your operations and not only your revenue, but also how is the revenue being collected?
That's an important distinction.
It is, because monitoring how revenue is collected at every point in your process is actually where you're going to get paid.
Absolutely. What are the reasons that we see that lead to those situations of seeing big discrepancies?
Well, a big one is the manual processes. And I know this term gets thrown around a lot. So let me walk through this just a little bit with you to see what it might look like. So think of value-added services. They're an important part of any 3PL as a source of additional revenue and also a competitive advantage in the sales process. So take, for example, pallets that you use every day, right? Most warehouses purchase the pallets regularly, and then they're stored and they use to ship the product out the door. In the contracts, you should be able to bill back all those pallets that you use to that customer for the product that, their product went on. What happens if you don't have an accurate count of what you received? What about if, you don't know which orders the pallets were used on? What if you don't even know how many pallets were used on an order?
That's a great example, Tony.
Well, another one that we see is a lot is, delayed data. A lot of the warehouses collecting, they're collecting the right information, but they're collecting it too late, right? Take detention fees, for example. A trailer arrives at the dock and it ends up sitting there for hours beyond the scheduled time. Operations knows it happened. The carrier knows it happens. The customer may even know it happened, but no one records the event when it actually occurs. Then about 30, 60 days later, a carrier invoice arrives and the detention charge on it. Now somebody has to figure out which customer it belonged to, what happened that day, who proved it, whether it should be passed through or not. At that point, the trail has gone cold. So the result is that many 3PLs simply absorb the cost because it's easier than trying to reconstruct the events, weeks later.
Even when the data exists, if it isn't captured at the right time, it becomes so much harder to bill accurately.
Exactly. Revenue events have a shelf life. The longer you wait to capture them, the more likely they're going to fall through the cracks.
Let's also talk about contract complexity. That's something that we hear a lot about. Most 3PL contracts are not simple. One customer might pay by pallet position, another could be by cubic foot. One customer might get 30 minutes of detention grace, and while another gets an hour. One customer could pay for return inspections, but another customer could have negotiated a different rate structure altogether. All of that makes 3PLs very complex in this regard.
It does. And you did a real great job of laying out different scenarios, but now imagine, trying to manage all those rules across spreadsheets, emails, historical knowledge. Maybe the account manager knows the agreement, and maybe the billing analyst has a copy of the contract somewhere, but maybe operations remembers part of it. But, the challenge is that nobody has a single source of truth. So what happens? The team defaults to the safest options, which is also often, sadly, underbilling it. They would rather miss a charge than risk sending an invoice that creates a, customer dispute.
Unfortunately, and the more complicated the contract, the more opportunities there are for revenue to get lost in the process.
Exactly. Complexity itself is not the problem. The problem is, the complexity relies on people's remembering of every detail.
And that leads us into another big issue we see, which is staff doing the work, but not always logging the work.
This is probably the most common form of billing leakage because it usually comes from employees just trying to help customers. So let's say there's a customer calls and asks for 30 SKUs to be pulled, right? Counted, labeled, staged for an early morning pickup. The supervisor says yes because they want to provide great service. That's sort of what they're there for, right? The team gets it done. They come together. The customer's happy. Everything's all well and fine. But after the work's complete, everybody moves on to the next priority. No one created a rush order charge. Nobody recorded the extra time to count and label. The work absolutely happened. Labor was consumed, equipment was used, time was spent, but because the activity was never recorded, there's nothing to bill, on the invoice.
And those small requests, they don't necessarily feel significant when you're in the moment.
Exactly. When you multiply that across dozens of customers and hundreds of requests throughout the year, it turns into real money. That's why we always say, that billing leakage is rarely one giant problem. It's usually a collection of small misses that add up over time.
Right. Okay, so we've introduced some of the common ways billing leakage happens. We understand better that this is not about malicious intent, but rather misalignment. Now we're going to break down the 6 biggest profit leaks that we see most often.
And don't get discouraged if any of these feel too familiar. We've also helped teams recover revenue caused by these. There is a path forward.
Absolutely. This is something that we are passionate about at SC Codeworks. We've seen firsthand the improvements that a solid system can help make. Let's go one by one here. The first leak that we see often is missing accessorials. Tony, talk about what kinds of things that this includes.
Yeah, this actually can add up really fast because it includes a number of things. So first, let's just, so we're all on the same page here. I want to talk about what accessorials are. These are the charges for services performed outside standard activities covered, by the customer base rates.
Right.
Right.
Standard activities typically defined as receiving, storage, order fulfillment. But as we all know, so much more goes on inside of a warehouse on any given day.
Right. So your accessorial billing covers all those extras. Right. Think about it like shrink wraps, restacking of pallets. You might do a lot of labeling or relabeling, maybe special projects or kit building. Sometimes it's an exception and sometimes it can be regular occurrence. No matter what, though, you should be collecting billing for those activities.
And the challenge is that these activities are usually happening on the floor where everybody is focused on serving the customer and keeping operations moving. Billing is often, unfortunately, an afterthought.
Exactly. So let's say a customer sends in that rush order and a request for, relabel of 500 cases before shipment goes out. The work gets done, the customer's happy, the shipment leaves on time, but if that relabeling activity never makes it onto the billing process, you just provide labor, material, and time for free.
When that happens once, it may not seem like a big deal, but when it is happening a couple of times a week across multiple customers, those missed charges quietly add up to thousands of dollars in lost revenue every month.
The important thing to remember is that it isn't usually a people problem, it's a process problem. The work was completed, the customer received the service, the warehouse earned the revenue. The breakdown happens when there isn't a reliable system connecting the work performed to the invoice that gets sent.
The second profit leak that we see is storage underbilling. This one surprises a lot of operators because most people think storage billing is pretty straightforward.
Right. You have the inventory in the warehouse, you bill for the space it occupies, and you're done. At least that's how it seems on the surface.
So talk about where things start to break down.
Well, one of the biggest issues is relying on the month-end inventory snapshot. Many warehouses calculate storage based on what's in the building on the last day of the month. The problem is that inventory levels often fluctuate dramatically throughout the month.
So if a customer's inventory spikes for 2 or 3 weeks and then drops before month end, that extra storage usage may never be captured.
Exactly. Imagine a customer normally stores about 500 pallets, but during a seasonal promotion, they temporarily increase to 1,500 pallets for the most of the month. Then they ship out those pallets after a few days, before the month closes. So if you're looking at the month end inventory, you can end up billing as if they only occupied 500 pallets, for the all month long.
Meanwhile, you still had to dedicate warehouse space, your labor, equipment, all of your resources to support that peak inventory level.
And that's the hidden profit leak. The warehouse provided the capacity, but the billing doesn't always reflect the value delivered.
And that's where daily inventory visibility becomes so important.
Absolutely. When you see inventory levels throughout the month, you have options. You can bill based on daily averages, peak occupancy, or whatever method aligns with your customer agreements. The key is to having accurate visibility into what is actually stored, not just what happened to be sitting in the warehouse on the last day of the month.
Just like our first example, this isn't usually a case of someone forgetting to do their job. The inventory, is probably tracked and the space was definitely used. The customer received the value. The challenge is just making sure that when you're billing, you're capturing the full picture.
Exactly. And when it doesn't, storage underbilling can quietly become one of the largest sources of lost revenue in a warehouse operation.
The third leak that we see is unbilled customer-driven exceptions. So these are situations where a customer requests something that is outside of the normal workflow. The warehouse responds and gets it done, but the additional work or expense never makes it onto an invoice.
And these happen every day. Warehouses are built around customer service, so when a customer has an urgent need, operations team jump into action.
Right. Talk about some of the examples of this.
Well, let's think about the rush order again. Okay, you have a rush order that has to ship today. Maybe the inventory needs to be pulled and reworked at the last minute. Maybe there's a shipment changes after processing has already started. Or maybe a customer-driven issue results in detention charges from a carrier. In every case, the warehouse is providing additional service or absorbing additional costs beyond the normal scope of work.
And the priority here is always solving the customer's problem.
Exactly. The customer has a problem, the warehouse solves it, point blank. Everyone gets focused on, getting the shipment out the door, meeting the deadline, keeping the customer happy. The billing side of the equation often comes later, if it comes at all.
Yeah, and that's where it gets a little dangerous because the work gets completed, but the charge never gets recorded.
Right. Everyone remembers the fire drill. Everyone remembers staying late to get the order out, but unless there's a process to capture those exceptions and convert them into a billable charge, the warehouse ends up absorbing the cost.
It's not usually because the customer refuses to pay either.
That's an important distinction. Most of the time, there isn't a dispute. The customer may even know that there's an additional charge to bill. The issue is that the event was never documented, connected with the customer account, or included on the invoice.
And you mentioned this earlier, but detention charges are a great example of that.
Oh, absolutely. If customer-driven issue causes a carrier detention charge, the warehouse pays for the expense immediately. The challenge is, can be trying to recover it later. Someone has to document what happened, determine responsibility, make sure that the charges get passed through correctly. If any part of that process breaks down, the warehouse has to absorb a cost that should have been recoverable.
Right, which means that, even though the warehouse delivered the value, or in this case, incurred the expense, they may never collect the revenue.
Exactly. So whether it's an expedited processing, last minute changes, special handling requests, or even customer caused detention, these exceptions consume labor, time, and resources. If they aren't consistently captured and billed, they become a significant source of revenue leakage.
Exactly. And just like the other profit leaks that we've discussed, the value is delivered, the revenue is earned. The breakdown is that having a reliable process or not having a reliable process, connecting those exceptions to your final invoicing.
And that's why unbilled customer-driven exceptions remain one of the most common ways warehouses lose revenue they've already earned.
The fourth leak that we see is returns processing.
And this one is especially common because returns often feel like no part of doing business. But from a warehouse perspective, every return creates work.
Walk us through that, Tony.
So a customer return arrives at dock. Someone has to receive it, inspect it, verify quantities, determine disposition, update inventory records, or often put product away or move it to a separate location. Sometimes it needs to be repackaged, relabeled, quarantined, or even disposed of.
So in other words, returns are not just inventory moving in the opposite direction.
Exactly. Returns create work. Work creates cost, and cost must create revenue.
That's a really simple way to think about it.
The challenge is that in many warehouses, they do an excellent job of processing returns operationally, but don't have a consistent process for capturing all the associated billing. The returns get handled, inventory gets updated, and the customer gets information they need, but the labor and resources involved never make it onto the invoice.
Why is that happening?
Because returns often involve multiple steps across different teams. Receiving may get to touch it, inventory control may touch it, customer service may get involved. The work gets spread across the operation, making it easy for billable activities to slip through the cracks.
And, customers may not realize how much work is actually involved in these returns.
That's right. And they see a return product. The warehouse sees receiving activity, inspection time, and, inventory adjustments, storage decisions, reporting, administrative work. every one of those activities consume resources.
Right. So, the warehouse is still delivering that value, even though no new outbound order was shipped.
Absolutely. In many cases, returns require, just as much effort as an outbound processing, sometimes even more. Yet they're frequently underbilled or not even billed at all.
Which just means that the warehouse is absorbing costs that should be recovered through the fee structure they already have in place.
Exactly. The challenge is making sure every step of the process is properly captured and converted into a billable revenue.
So the fifth profit leak that we see is ad hoc requests.
Every warehouse has that customer.
I'm sure everyone listening can think of at least one right now.
Yeah, most operators can. They're a great customer. You've worked with them, together for years, but they call with one-off requests that seem simple enough to handle.
Yeah, and that can include things like an inventory check or a special report or, sometimes emergency requests.
Exactly. So maybe they need an inventory physically verified before an important meeting. Maybe they need products staged early for a carrier. Maybe they call asking for an emergency pull or same day inventory count. Sometimes it's a it's a custom report that requires someone to stop what they're doing and gather the information.
And the problem really lies in that none of those requests seem significant on their own.
But that's what makes them dangerous. Each request may only take 15 minutes, 30 minutes, maybe an hour. The team handles it, the customer appreciates it, and everyone moves on.
Like you look at the total volume of those over time.
Right. One favor doesn't hurt profitability, but hundreds of favors do.
Now, I want to go back to something that you said a minute ago that I think is important. Talk about what you mean by special reporting becoming a profit leak.
So, yeah, think about it. Think about times when a customer asks for information that isn't available in a standard dashboard or report. Maybe they want inventory aging data, lot level analysis, a custom shipment history, or even a detailed reconciliation. It sounds like a simple question, but someone in the warehouse team has to stop what they're doing, gather the data, verify it, organize it, and deliver it.
In these situations, what looks like a quick question can actually consume a significant amount of time.
Exactly. So customers see the report. They don't see all the hours that went into creating it. And then, because those requests, they often arrive through an email or a phone call, they rarely get connected to a formal billing process.
Which means the warehouse is, again, providing valuable information and expertise, but they may never charge for it.
Right. So in many operations, customer reporting has quietly become a free service. The warehouse keeps saying yes because they want to go above and beyond. They want to be responsive, but over time, those requests consume labor and management attention, that should be accounted for.
Exactly. I think it's so important to mention here because I know the types of reports that I've provided over the years. They are key to business needs and customer relationships. It's just important to capture the time that you're spending on them. Why do you think that these requests are so often missed from a billing perspective?
Because again, they usually happen outside the normal operational workflow. There's no order, there's no receipt, there's no standard transaction that automatically creates a charge. Someone sends an email, makes a phone call, or stops by a desk with a request, and the warehouse simply gets it done.
Such a great point to note. When there's no natural path to invoicing it, your profit margins are at risk.
But the irony is that these requests often represent some of the highest value service that warehouse provides. The customer needs something unusual, urgent, or customized, and the warehouse delivers. That's real value. But if the activity isn't documented and tied to a billable process, the warehouse ends up giving that value away for free.
And just like the other profit leaks that we've discussed, this usually is not intentional. In fact, it's not intentional. I know we keep repeating that, but it's so important to keep in mind.
Everyone's just trying to provide great customer service. The challenge is creating a system where exceptional service and proper billing can happen at the same time.
Because providing value and capturing revenue should not be mutually exclusive.
Exactly.
So the sixth and final profit leak that we see is forgotten contract escalators.
And this is probably the simplest money a warehouse will ever recover. In most customer agreements, there's an annual price escalator built in, typically 3 to 5%, sometimes tied to a CPI or a fixed schedule. These increases are already negotiated, already approved, and already part of the contract.
That means that the revenue is technically already earned.
Exactly. The warehouse and the customer have already agreed to it. The challenge is, in many of the cases, those escalators never get applied when billing is updated.
Tell us about some of the reasons that that happens.
It usually comes down to processing gaps, right? Contracts get renewed or rolled over, rate cards get copied forward, or billing systems aren't updated consistently. So the warehouse continues invoicing at last year's rates, even though the agreement allows for an increase.
So over time, the gap between what should be billed and what is billed just keeps growing and growing.
Right. And because it's incremental, it often goes unnoticed. A 3% increase doesn't feel dramatic month to month, but over a full year across multiple customers, it becomes a significant amount of missed revenue.
And unlike some of the other leaks that we've discussed here today, this one isn't about capturing new work or new exceptions.
Exactly. This one is already earned revenue sitting on the table. No extra labor, no additional operational effort, just ensuring the agreed upon contract terms are actually reflected in the billing system.
I think this one so commonly gets missed because it sits at the intersection of operations teams, finance teams, account management. Everybody, probably assumes that somebody else is tracking it.
Exactly. The work hasn't changed. The service hasn't changed, but the billing hasn't kept up with the contract.
And that means predictable revenue is just quietly being left behind.
Right. And like I said, the simplest money in the warehouse operation is often the most overlooked. Annual escalators that are already agreed to, but never implemented, fall into that category.
Right. So we've walked through the 6 biggest profit leaks that we see in warehouse operations. The question becomes, what separates operations who don't struggle with these issues?
The short answer is they don't rely on memory.
What does that look like in practice?
Well, high profit 3PLs don't depend on someone remembering to capture a charge at the time. At the end of the day, they don't rely on spreadsheets to get updated after the fact. They definitely don't rely on someone telling finance what happened at the warehouse last week.
So what do they do that's different?
Well, they design their processes so billable activity is captured at the moment it happens.
Okay, break that down for us.
So first, they capture the event at the source. If something happens at the warehouse, whether it's a value-added service, an exception, or a special request, it gets recorded as a part of an operational workflow, not after the fact.
So the activity itself is what's triggering that visibility.
Exactly. So then they tie that activity directly to the customer account. There's no ambiguity. There's, about who the charge belongs to or whether it should be billed. It's connected from the start.
And that prevents things from getting lost between those operation teams and finance teams.
Right. And, next, they automate, rating wherever possible. Instead of manually calculating charges or relying on someone to interpret a rate sheet, the system will apply the correct pricing based on the predefined rules.
That's great because it reduces the risk of human error or mischarges.
Exactly. So, but after that, they automate billing workflows. So once the event's captured, it flows directly into invoicing without needing manual intervention or follow-up emails.
And that's great because there's no waiting for someone to reconcile everything at the end of the month.
Right. So, and finally, they create operational visibility. leaders can see in real time, what the work is being performed, what exceptions are occurring, and what revenue is being generated or is at risk.
So instead of reacting at the end of the month, they can manage it in the moment as it's happening.
Exactly. And when you put all that together, something important changes, right? The goal isn't better invoicing. The goal is making every billable event visible the moment it happens.
That really reframes the entire conversation that we've been having today.
It does. Because once visibility is built into the operation itself, most of the profit leaks we've talked about stop being leaks at all. They become captured revenue by default.
That's awesome. That by default is the key there.
Mm-hmm.
Okay, so we have gotten a few questions and I want to go through them. So first question here, we've used spreadsheets for years. Why should I change now?
Well, because spreadsheets only work when the environment is simple and the volume is low, right? The moment you have multiple customers, multiple exception types, and daily operational variability, spreadsheets stop becoming a system and start becoming a delay. Most of the warehouses don't fail because of lack of effort. They fail because the information needed to bill accurately is scattered across emails, whiteboards, conversations. Spreadsheets just become the place where people try to reconstruct what actually happened. The risk isn't that spreadsheets are bad. The risk is that they depend entirely on a perfect human behavior to stay accurate.
That's a really good point there. So second question, and it's really more of a comment, someone saying, I'm worried that customers will push back if we start billing everything.
Only if it wasn't in the contract. Okay. So in most cases, pushback doesn't come from the existence of charges. It comes from surprises or inconsistency. If a service is a part of the agreement and consistently applied, it usually isn't controversial. The bigger issue we see is internal hesitation. Warehouses often underbill because they assume the customer will object, even when the charge is legitimate. The irony is that most pushback concerns are actually internal confidence issues and not customer behavior issues.
That's interesting and a good point too. The contract is your safety net in those situations.
Exactly. Yep.
Yeah. So the next question, what if our WMS already has billing? I'm covered, right?
Well, most systems can generate invoices. Far fewer are designed to ensure every billable event actually gets captured in the first place, right? So the gap we've been talking about today isn't invoicing, it's visibility at the moment the work happens, right? If an activity never gets classified as billable, no billing system in the world will ever recover it later. High-performing operators don't just rely on billing functionality. They rely on event capture, workflow design, and consistent classification of work as it happens.
So out of curiosity, Tony, which of the 6 leaks, in your opinion, usually causes the most revenue loss?
I would say it depends on the operation, but it's rarely the obvious ones like detentions or returns. The biggest leaks are usually the ones that feel small, ad hoc requests, special reports, or missing accessorial capture. That's because they happen consistently across every customer, and they never show up in a single large visible problem. They show up as a dozen small gaps every day.
That's by 1,000 cuts. So here's one that asks a good pointed question. Is this really a revenue problem or is it an operations problem?
Both. But it shows up as a revenue problem, obviously. So operations is doing the work. Finance is doing the billing. The gap happens in between, right? When those two sides aren't tightly connected through the system and workflow, you don't just get inefficiency, you get uncollected revenue. And the key to that takeaway from today is simple. The warehouse already earned the money. The question is whether the system captured it, right?
Right. That's a good point. So last question here. Where should a warehouse start if they want to fix this?
Start with your visibility. You can't fix what you can't see, right? Most operators, jump straight into pricing or audits, but the real issue is early in the chain, capturing what happened in the first place. Once that's in place, everything becomes much easier to correct. If I had to prioritize, I'd start with accessorials and ad hoc requests.
Thank you, as always, Tony, for answering all of those questions. There are so many conversations and questions that can be sparked from this topic.
Absolutely. I'm glad we were able to dig into this today. One of the things I love most, about this work is helping companies, get more out of what they do. We don't work with any nonprofit warehouses, so when we get a chance to help our customers realize the revenue, the more revenue, it's a good day.
Good point. And you're right. We help our customers with this automatically when they use Codeworks Enterprise. So we wanted to dive into this so that we could open the conversation with others out there that might be realizing that they need to evaluate their own billing.
And I'm excited because we've put together the same audit framework we use when we evaluate billing leakage into an easy checklist that you can use and download to determine how big of a priority this should be for you.
Yes, and we are going to include the link to that in the comments on this video.
If you'd like us to review your results, benchmark them against what we see across the industry, or discuss ways to automate the process, please schedule a call and a conversation with our team.
We love getting an opportunity to talk with others that are seeing this every day. Thank you so much for joining us today, and we hope to catch you on the next Code Chat.
Thank you, everyone. I hope you had fun, and we'll connect again.